Compulsory superannuation contributions from your employer will increase from 11.5% to 12% in June this year. Australia is one of the biggest holders of pension funds since the Superannuation Guarantee was introduced by the Hawke and Keating governments in the early 90s. This was to reduce the reliance on publicly funded pension systems, which, in a time of an ageing population that has a smaller base of taxpayers to fund pensions, is vitally important. But unless you're approaching retirement age, super can be a complex mystery that's easier not to think about. Philip McGann from Claritude Financial Planning, however, is fascinated by super, and he joins me now. Hello, Phil.
Hello, Kathy. How are you?
I'm very well. I start thinking about my super a lot as soon as I turn 60. I had given it some thought before that. Not a lot, because it is very complicated. What is the maximum amount that can be contributed to an individual's super fund each year? That's the combination of what the employer puts in and what the individual puts in. How much is that?
Right, but it's $30,000 on a concessional basis. So when you're looking at superannuation, there's two ways to get money in. It's concessional, which is contribution tax is paid on it. So that can be part employer or a salary sacrifice arrangement. Maximum is $30,000. Then there's another contribution called a non-concessional, which is a little bit different.
So the tax rate changes?
Yeah, correct.
So on a concessional what is the tax rate?
It's 15%.
Right. And then non-concessional, it's just whatever.
It's zero. So you can actually put after-tax money into super, and it's $120,000 a year. But it's basically more for people who are looking to actually have got a windfall or a lump sum of money, a sale of the house or something like that, and they're putting money into super. So what we're really talking about on the super guarantee is the concessional side. That's what most people are interested in, I suppose.
Yeah, because then that would come out of their salary before they see it?
Yeah,
like
that's right.
That's what a salary sacrifice is.
Basically, an employer is obliged to put in on your gross salary 11.5% of the the gross salary as a super contribution. That's rising to 12% on the 1st of July this year, and that'll cap out, so that'll be 12%. The most dollars you can put in from the employer and you salary sacrificing is the $30,000 a year.
How long has it been at $30,000?
It's only been for the last couple of years. Before that, it was $27.5. Before that, it was $25,000. So they basically gradually put it up. They don't put it up each year on a CPI adjusted basis because you'd end up with funny amounts, 25,702 or something. So they wait for a few years until there's a round number, and it was 27,500 for a few years. Now it's $30,000.
Is it wise to salary sacrifice the additional amount? Say your employer is putting in 3/4 and then you put in the other quarter as a salary sacrifice?
Potentially. Look, it's very much, obviously this conversation is very general in nature, but it's a very personal, individual scenario you're looking at there. Whether you should salary sacrifice or not, and all salary sacrifice is you're basically sacrificing income now to put it into super to consume later on. So it's deferred consumption. That's all it is. So you basically are allowed, the government will let you put 30,000 all up. Your employer puts every year, they've got to put in the 11.5, and you can put more in if you want, but up to that 30,000. Whether you should depends on the individual circumstances and whether it's a good scenario for you. Does it make sense? For most people, it probably does, but you are sacrificing money. So if you've got a different stage of life and you've got lots of expenses and kids and mortgages and things like that, it may not make as much sense to defer that consumption for 30 years down the track. But if you're in your 50s and commitments are lower and school fees aren't there and the mortgage is gone or whatever, you may be best to contribute as much as you can in up to that cap, and that's the $30,000.
And then regardless of the cap, your after-tax income, if you decide at the end of 6 months that you've got some spare cash lying around, you can put
more money. Yes, that's after-tax money.
After tax, and then do you pay tax? Any more tax?
No. So you don't pay that. It's a non-concessional contribution then on that side.
And if you put that money into your super, where does this thing called compound interest come in?
Well, basically the compounding, all superannuation is a trust that holds your money for your benefit in retirement. And you basically invest those funds inside the super fund. You can choose, or if you don't tell the super fund, they'll just invest it in a default fund. And the compounding happens from just all of the interest or the earnings on the investments compounding over time. So super is a very much the ultimate long-term investment. You can't get it back until you retire, so it can be decades and decades in there, and you're compounding things away. So you're basically, whether it's in a cash account earning interest or whether it's in the share market earning dividends, they're reinvested back in. No money comes out; it just stays in the fund and compounds away. So it can be quite lucrative, and the compounding works like magic. Works out quite well. Just I'll go back one step.
Okay.
The concessional contribution, the cap is $30,000. But if you don't use your $30,000 cap, and because of circumstances you don't have the ability to forego that much income, the government put in place about 5 years ago a scenario where you can carry forward the unused cap.
Really?
Yes, and you can actually make use of it if your super balance is under $500,000 at the end of the financial year. That covers quite a lot of people. So they look at it and they say, super balance is under 500. Have you used all your concessional cap up? No. And you add it all up, and you can basically see, I had a client the other day, a new client come on board. They had about $60,000 available, an unused cap. So they had the funds, so we could put those in, claim a tax deduction for it because their super balance was lower than the 500,000. It works really well, particularly for women who've been out of the workforce with child raising duties.
So they miss out on that income earning period.
That was the whole point of they brought it in and they bring it forward, and it basically just allows you to catch up the contributions, and it can be quite good. Now it's been around for 5 years now. It's a rolling 5-year period, right? So the first year will drop off, but there's always a 5-year period there, and it can be quite a lot of money that people can put in if they have the ability or the cash flow to do that, and it just comes off your taxable income. So you can basically have a tax deduction for that. So again, individual basis, you'd need to see whether it's worth your while to do so. Don't rush out and do anything just on this conversation, but have a chat to someone about what is suitable for your circumstances.
My name's Kathy Schnitzling. You're listening to 612. No, not 612. I'm sorry. You are listening to ABC Local Radio, and I'm talking to Phil McGann from Claritude Financial Planning about superannuation. If you've got a query about super, you can give me a call, 1300 800 222, or you can text 04679 22 612. Phil, if one spouse isn't working for whatever reason and the other is, can the one who's working contribute to their partner's super?
Yes, you can, but there's a limit on tax deductions on that side. So there's a spousal contribution. You can basically make a contribution in for your low income earning spouse. It's up to $3,000 maximum to get the maximum deduction, which is 18 cents. So it's about $540 you get as a tax rebate at the end of the year for the party putting the money in. But you can actually do something even a bit different again. You can actually contribution split with your partner. So if you've got a partner who's not working for whatever reason, you put money into superannuation via your normal employer or salary sacrifice arrangements. 85% of that can actually be split and given over to your partner or your spouse at the end of the year. Why it's 85%? Because the government wants a 15% contributions tax, so it has to be covered off there. So it's a way to, if you've got a high income earning party and someone who's not at home or whatever, you can actually split those contributions over.
And do you make those arrangements through your super fund?
You've got to do it through your super fund. There's just paperwork involved, and all super funds are under the one legislation, so you actually just have to approach them, work it through, or deal with your financial planner who will handle it all for you.
What about contributing to the superannuation fund of one of your children?
Well, this is an interesting concept because on one hand, superannuation is a very good long-term compounding, low-tax environment. But do you really want to put money into your child's superannuation? And there are limitations on what you can do. Say you can just put money in. That might be 50 years down the track for a 10-year-old. That's a long time. Access to super now is at 60 as a minimum. But what will it be in the future? Who knows? It'll be higher, no doubt. So is that a better way to go than trying to invest those funds for a child outside of super in a tax advantage scenario to give them access to those funds earlier? for house purchases or those sorts of things.
Okay, yeah.
It's a long time away. So you can do it technically. Is it a good idea? Well, it depends.
It depends.
On the individual circumstances. And that's, again, personal information you need to sort of discuss with the individual.
Ron from Oxley in Brisbane has a question. Hello, Ron.
Good morning.
You have a question for Phil.
Yes, with our employer super contribution, they only have to lodge that into our super account once a quarter.
Correct.
But
yes.
if we are salary sacrificing, it means that they are deducting funds from our weekly pay. Do they have to lodge that salary sacrifice contribution weekly, or do they hold on to it and only lodge it quarterly?
I'm not 100% sure on that one point. I would think it's probably they could do it on a quarterly basis. The legislation is employers are making contributions in. They only have to do it on a quarterly basis. They are changing the laws, and that will come into place, but not another 2 years hence. So they'll have to do it on when you get paid. Now, I would think for your employer, if they're taking money out, salary sacrifice, they wouldn't have a contribution in. They'd just wait for the end of the quarter. Now, is that a bit underhanded? Yes, no, maybe. I mean, it's one of those things that it all depends on how the markets are going at the time as well. It doesn't particularly matter to a big extent. You are talking 12 weeks. So would it be better to go in on a weekly basis? Potentially, but the markets might be favourable to you as well, Ron. As long as your employer is putting it in when they have to, they're not doing anything wrong. They're going by the legislation. There are some employers out there who don't make contributions, which is a terrible thing, but it's getting tighter and tighter all the time. So I think in your scenario, Ron, have you seen that? You've just been seeing your contributions going quarterly, including your salary sacrifice?
Well, I've just started with a new employer, and I'm contemplating whether I start salary sacrificing through this new employer.
Right.
And I just thought it was. I just wanted to know for security reasons whether that money was actually being transferred into my account weekly, or whether there's a possibility I may not even see it at all if the employer, as happened with my last employer,
didn't pay.
Didn't pay it. Yes.
Look,
plus missing out on the compound interest.
Correct. Yeah. I would front up to the paymaster and ask the question directly. When do you pay super? You're obliged on the super guarantee quarterly. What do you do? Salary sacrifices are quarterly as well, and then make a decision. If they don't do it, if they only do it on a quarterly basis, there are ways and means that you could actually make a personal contribution and then claim a tax deduction for it later on. So you get after-tax money out, put money in yourself via your super fund, BPay or a direct debit, and then you claim a tax deduction. It's a bit more of a fiddle, so to speak, but the end result is the same, and you actually do get the contributions in when you want them to, but the employer is not obliged to put their contributions in and anything quicker than a quarterly basis at the moment.
Thank you very much for that call, Ron. I have a question here. No name on the question. Is there any difference between making salary sacrifice contribution through your employer and making a personal contribution and claiming a tax deduction?
That's basically what we were just talking about a moment ago. So effectively not really, because the end result's the same. So whether the employer puts the funds in and you actually get taxed at a lower, you don't get taxed in your pay packet, but it actually gets taxed at the super fund level. The other way is you're actually getting paid yourself. Marginal tax rates are taken out into your bank account, and then you make a contribution in yourself and claim a deduction at the end of the year. It's more of a timing issue. So, no, I don't think there's any real difference on that basis, no.
Gabriel from Seven Hills in Brisbane has a question. Gabriel, what is your question for Phil?
Good morning. How are you?
Good, thank you.
Very good.
Okay, first thing is I actually had I was in a de facto relationship. We separated. He moved on to a new family, had his own didn't have a family, moved on to a new partner. We had 2 children while we were together. He has passed intestate without a will. I was listed as his beneficiary on his superannuation. Will that be deemed as a binding beneficiary, or will it go to the trustee and back to his estate and then be divvied up?
Basically, what you're getting at there is superannuation funds are governed by trustees, and the legislation says that if you've got a binding death nomination in place, signed by the the individual owns the account, they can direct or bind the trustees of the super fund where those funds are to go. So if you've got a binding agreement or a binding death nomination in place with the super fund signed by your late partner, you should have a good case for the trustees to do. Have you contacted the super fund and discussed that with them?
No, I haven't. The issue is I don't have any of his personal information.
Right. But do you know where the super fund, which super fund it is?
Yeah, I do, yeah.
Give them a call and sort of see. Look, it's probably a little bit outside of the realms of what we're talking about here, but that's a very particular point that you need to be looking at, and there's rules governing the binding death nomination. So I'd suggest that you have a chat directly to the super fund and see what they can find out for you.
Thank you so much.
That's okay.
Thanks, Gabriel. I do have a message that has come in from Anita, who's a contract bookkeeper. We were talking about the question of how often should your employer pay your salary sacrifice into your super. And Anita says if it's salary sacrificing, they have to pay it monthly. I have also another question here. Sorry. Chris from Barden in Brisbane says, is it worth changing super funds in a similar way that you change your electricity or insurance provider, or is it not worth it due to costs? I switched super funds last year and have since had a couple of unhappy interactions with the fund, and I'm thinking of switching again. Is it as simple and easy as switching your electricity?
It's a little bit more difficult, but it's a lot better than it used to be. Should you change super funds? It's really jumping from one to another to another. They're all fishing in the same pond to a certain extent. The interaction. What you're talking about there is the poor interactions with the super fund. It's got nothing to do with the performance of the fund. It's the way their customer service works. So that's a different thing altogether, and it all depends how much value you put in that versus what sort of returns and what fees they do charge.
Show me the money. Go to the money.
Yeah,
follow
correct.
the money.
But at the end of the day, I'm a financial planner. At the end of the day, the performance is what really matters. The interaction is important, but it's not as important as the compounding over time. Having said that, the difference in super fund fees is considerable, potentially. Industry funds are quite low cost. They're a profit for member scenario. Retail funds can be dearer, but they offer more bells and whistles on the investment choices you do have. So it all depends what you're looking for to achieve from your super fund, whether it's worthwhile swapping. I don't think it's a good idea to swap too often, because whilst there's it's a bit of a fiddle to do so, but it's more a case of there are costs involved because they've got to sell the assets, and then you go to a new fund and they buy more assets for you. So the transaction cost, we call it a buy-sell spread of selling the assets and buying more. That's a cost that you bear. So if you're talking about hundreds of thousands of dollars, it can be quite a bit of money. And if you do it too often, there's that churn. It does take the edge off the returns.
Richard has sent in a text on 0467 and he says that he is frustrated because with superannuation, if you're in an extended period of unemployment and haven't had any super contributions since January 2023, that's Richard, but the fund keeps taking out its fees.
They do. Well, from the super fund's point of view, they will basically, they're still got incurring costs. Now, you aren't working, which is no good. You've got no contributions going in, but there are still funds invested there and they're actually doing something for the fees they're charging. And yes, they're charging a fee, but the returns over the last 12 months should have been fairly good. So the fees as a percentage of that shouldn't be too high. So it shouldn't be too bad unless you've got a very small balance. Right? So it's just one of those things that you've got to be cautious of, that the fees don't chew up too much of the capital. But super fund fees have been coming down consistently over the last 10 years. They're a lot cheaper than they used to be, but you need to have a look and compare yours to others.
Yeah, the scrutiny certainly helps. Anthony from Ferny Grove has called in and he wants to know what happens to his super if he passes away. He may be on the side of a road somewhere. How much tax will he pay? Hello, Anthony. Your line is very noisy.
I am pulled over on the side of the road, and it's a busy road, unfortunately.
That's okay. So, Anthony, you're asking the question about what happens to your superannuation balance in the event of your death.
Now, that's fundamental question, yes.
Yes.
But I do know that when my if I pass away, it all goes to my wife.
Yep.
When my wife passes away, we leave it to our three children, and there is a tax applied to the amount in the portfolio. I believe it's 17% of 80%.
Yeah, correct. But basically, what they're getting at there, and it can be very complicated, but effectively, when you put money into superannuation, for most people, it's on an employer basis, salary sacrifice, and there's tax that sort of accumulates in the fund. Once you get to superannuation pension age, and you actually set up a pension, there's no tax in the fund, but the components of the taxation components are always still there. If you die and passes on to your wife, there's no tax. If your wife dies and passes on to adult children, there's actually tax payable. So Anthony's correct in that regard. And it's levied at the amount of the taxable component of the fund. And it's 17%. It's basically, people say there's no death duties in Australia. There is. Inheritance tax, that's what it is. But there are ways and means of actually avoiding that and manoeuvring funds around to actually to reduce that liability or get rid of it altogether. But it can be a bit convoluted and a bit complex probably to talk about now. But I always say to clients, if you know when you're going to die, pull all your money out of super and give it to your kids. But no one knows when they're going to die. That's the drum.
Sometimes. I'll leave you there, Anthony. I hope that answered your question. It's just that your line is really, really noisy. I do have, however, Jennifer from Singleton has called in. Pretty straightforward question from you, Jennifer.
Yes, I'd just like to know, is there an age that you have to start drawing your super down?
No. Basically, effectively, everyone thinks once you get to a certain age, you have to take money out of super. You don't have to, but there's a benefit in actually setting up what's termed an account-based pension from your superannuation once you're eligible to do so. There's preservation age, which for most people these days is 60. It was a little bit lower earlier on, but it's 60 effectively now. And once you actually meet a condition of release in that you're retired or you cease gainful employment from one employer, you can actually set up an account-based pension. The reason you would do so is you don't pay any tax on the earnings of the fund. Right? And the funds that come out, the pension that gets paid to you, is not taxable in your hands. So it's effectively a tax-free asset. So whilst you aren't obliged to take money out of super at a certain age, if you don't, you're penalising yourself. The government will keep on charging the super fund tax at 15 cents in the dollar on the earnings because it's still an accumulation fund. But if you're eligible to set up a pension, set it up. That's the best thing you could do. Now, again, individual circumstances, you need to talk to individuals about what their circumstances are and where things are going. But as a general comment, setting up an account-based pension as soon as you're eligible to do so is a good idea, mostly for the taxation benefits, because it's probably about 1% of the balance a year. So if you've got a super fund with $500,000 in it, it's a $5,000 windfall each year that you don't actually have that up in pension mode.
There you go.
Okay. All right, thank you.
Thank you. That is Jennifer from Singleton. Kelly from Petersham has a text message that she sent in and said that she worked in the UK for a number of years. Can I transfer my super from there back to here?
It's very, very difficult to do so. Now, the reason I say that is a number of years ago, there was a few super funds that were in Australia were eligible to receive money from the UK. It's a UK government Chancellor of the Exchequer scenario where they restrict people putting money in different countries unless their rules are very similar to their own. Now, my understanding is there is only one or maybe at least one super fund in Australia that's eligible to receive that, or you can go through a process where you set up a self-managed super fund to do so, and it can be quite expensive to do so. So she needs specialist advice on that to actually set those up and to help in the manoeuvring of funds away from the UK back to Australia.
You're listening to ABC Local Radio. My name's Kathy Schnitzling, and I'm speaking to Phil McGann from Claritude Financial Planning about the ins and the outs and the intricacies of superannuation. Phil, I'm aware that you can select low, medium or high risk investment strategies in your super, which means that you can know that you're going to earn the set amount each year, or you might earn a lot or you may not. Do most people know where their super fund is investing their money?
No. I'll give you an example. The biggest super fund in this country is Australian Super. Australian Super's got approximately $330 billion in the fund in total. If you don't tell Australian Super where to invest your money, and there's lots of investment choices, high, low, medium, Australian shares, international shares, whatever, if you don't tell them, they put you in the default fund, and the default fund is a balance fund. The balance fund has 70% of that money in it. So that one fund with Australian Super has got $220 billion in that fund. It's just sitting there. It's done well over the last 10 years. I think it returns about 10%. But there's no choice. People aren't making an active choice on what they're investing in. The best thing you can do is to tell your super fund how you want your money invested.
How do I know?
You talk to a financial planner.
Okay, right. Well, that would be the right answer.
That would be the right answer. So, look, it's important because if you're getting 1 or 2% different return percentage per year, that works out a lot over a working life. So getting good advice is it's definitely worthwhile.
Fascinating conversation. I know that we could probably talk for another hour about this, but then there would be people who would be losing the will to live, I'm sure. But it has been very educational. Thank you very much, Phil, for coming and joining me.
That's okay. Lovely to
on the radio.
Thank you.